Is the silver bull market over? Here's what you're not being told. Silver just hit over $114 per ounce. And right now, while you're watching this, financial media is trying to convince you the party's over. They're telling you to sell, they're saying it's peaked, they're warning you about a crash, but what if I told you they're not just wrong, they're dangerously wrong? And what's actually happening in the silver market right now is something most investors won't understand until it's too late. I'm recording this on January 28th, 2026, and the information I'm about to share with you goes against everything you're hearing in mainstream financial coverage. But by the time we're done here, you'll understand why this so-called peak might actually be the floor for what's coming next. Drop a comment right now with your silver price prediction for the end of February. I'm tracking these and calling out the wildest ones in next month's video. Here's what everyone's missing. When silver jumped over 270% in the past year, most people saw exactly what they've been trained to see. Massive spike, bubble, time to get out. That's the reaction Wall Street wants, because it keeps you from seeing what's actually driving this move. This isn't speculation. This isn't retail mania. What's happening right now is a structural break in the global silver market that's been building for 5 consecutive years. Let me give you the first piece that changes everything. Picture this. For 5 straight years, the world has been consuming more silver than miners can dig out of the ground. We're talking about 820 million ounces of missing silver since 2021. That's not a typo. That's an entire year's worth of global mine production just gone, pulled from vaults, from storage, from existing stockpiles. And those stockpiles, they're nearly empty. Want to know how bad the physical shortage really is? COMEX silver inventories, that's the exchange where most silver futures trade, have collapsed from 150 million ounces to just 46 million ounces. That's a 70% drop. They've burned through more than 100 million ounces of inventory in just a few years. At current demand rates, that's weeks of supply, not months. Weeks. Shanghai exchange stocks fell to their lowest levels since 2015. London vaults have seen massive drawdowns as metal flows to Asia. And here's the kicker. When people are willing to pay over 5% just to borrow silver for a few weeks, that's not a technical indicator. Think about it. That's like paying someone $5,000 just to borrow their car for a month. Desperation doesn't pay those rates. But it gets even crazier. On January 27th, Trump threatened to raise tariffs on South Korea from 15% to 25%. And I know what you're thinking. What does a tariff on South Korea have to do with silver? Everything. South Korea isn't just another country. It's one of the most critical nodes in the global supply chain for semiconductors, advanced manufacturing, batteries, and industrial electronics. Here's what most people miss. South Korea makes the semiconductors that go into electric vehicles. Those EVs need silver contacts and wiring. When you slap a 25% tariff on South Korean goods, you're not just making cars more expensive. You're making every manufacturer who uses those Korean semiconductors start hoarding silver right now because they know the next disruption could shut down their production lines for months. Suddenly, every multinational corporation with supply chains running through Asia has to ask uncomfortable questions. Do we stockpile strategic materials before the next tariff hits? And that question is the one that matters for silver. Because here's what most people don't understand about silver's role in the modern economy. Over 60% of silver demand now comes from industrial applications. Solar panels, electric vehicles, electronics, data centers, AI infrastructure. Once silver goes into these applications, it doesn't come back. It's consumed, gone. So when trade wars and tariffs create uncertainty about supply chains, industrial users don't wait around. They secure material now, regardless of price. Because paying a higher price for silver is infinitely cheaper than shutting down a production line. And then January 1st, 2026 happened. China just flipped a switch and said, we're keeping our silver. Over 120 million ounces of annual production just gone from global markets. No warning, no negotiation. They reclassified silver as a strategic material and restricted exports. Most investors still don't even know this happened. Add Mexico dealing with environmental shutdowns and regulatory challenges. Peru and Chile facing labor disputes. When you add it all up, available global supply could drop by over 100 million additional ounces. And remember, we're already running a deficit before any of these restrictions hit. Now here's the part that should terrify anyone who thinks silver has peaked. Let me tell you something that should make you furious. For decades, banks and exchanges have been selling you silver that doesn't exist. They promise you metal, And when you ask for delivery, suddenly there are delays, premiums, and excuses. For every ounce of physical silver that can actually be delivered, there are many more ounces promised on paper. This worked fine when nobody asked questions, but trade wars don't let you roll contracts and hope for the best. They force companies to say, "Give me the actual metal now." And that's when the whole house of cards starts shaking. Here's where it gets interesting. When silver hit over $107 per ounce, it didn't immediately reverse. It consolidated, it absorbed selling pressure. It refused to give back ground, even as commentators called it overextended. That's not topping behavior. That's base building behavior. And if you understand what that means, you understand why we're nowhere near done. In 1979, silver traded sideways around $8 to $9 for months after breaking out. Everyone said it was done. Then it exploded to $50. In 2010, silver consolidated around $18 to $20 after its breakout. Experts called the top. Then it ran to $49. See the pattern? Silver doesn't politely ask permission before it moves. It builds a base, absorbs all the selling pressure from doubters, and then it gaps. We're in that base right now, at $114. And most people are about to make the same mistake they made in 1979 and 2010. Here's what should terrify bears. The last time silver had a rally like this was 2010 to 2011. It went from $18 to $49 in less than a year. But that rally happened without supply deficits, without China restricting exports, without a trade war. We have all three happening simultaneously right now. If 2011 was a practice run, what does the real thing look like? And here's the part that should wake everyone up. While retail investors are being told to sell, what are institutions doing? Silver-backed fund holdings jumped 18% this year. That's 187 million ounces of silver pulled off the market by sophisticated investors who don't trade on headlines. They trade on fundamentals. And the fundamentals say we're nowhere near done. Before we go further, if you're realizing right now that everything you've been told about silver is backwards, hit subscribe. Because what I'm about to show you next is something 99% of investors will never see coming. The math here is brutal and simple. When silver moves from a properly formed base during periods of macro stress, it doesn't grind upward, it jumps. From current levels around $114, a 15 to 20% move puts us squarely in the $130 to $135 zone. And that's conservative for a metal with silver's volatility. But here's what really matters. That $135 level isn't a ceiling, it's a confirmation point. It's the level where denial finally breaks. Below it, skeptics can still argue the move is temporary. Above it, behavior changes. Risk managers adjust their models. Institutions that were underweight start scrambling to rebalance. Industrial users stop waiting for pullbacks and lock in supply regardless of price. The conversation shifts from, is this real, to how exposed are we? And that shift brings new capital into the market, not speculative money that runs at the first sign of trouble. Defensive capital, strategic capital, money that cannot afford to be absent. Now let's talk about what nobody's discussing. The dollar volatility we're seeing right now is exactly the environment where silver historically thrives. Not when the dollar is weak, but when the dollar is unstable. Trump's tariff policies don't just raise prices. They inject uncertainty into currency markets. They force foreign exchange traders to reprice risk overnight. They make global capital flows unpredictable. And when currencies start moving faster than models can predict, when the rules of trade can change with a single social media post, that's when confidence cracks. That's when silver stops trading like a commodity and starts trading like insurance. The metal doesn't belong to any central bank. It doesn't carry policy risk. It doesn't require a counterparty to honor a promise. Can't they just substitute silver with something cheaper? They've been trying for a decade. Solar panel makers have reduced silver content per panel by almost 50% over the last 10 years. And you know what happened? Total silver demand from solar still tripled. Because even with less silver per panel, they're making so many more panels that consumption exploded. You can't substitute your way out of an exponential growth curve. You're being told the silver bull market is over because the price chart looks scary to people who don't understand what's driving it. They see a vertical move and assume it must correct. But they're not looking at physical inventories hitting decade lows. They're not tracking lease rates spiking to levels that indicate genuine scarcity. They're not watching China restrict exports while Mexico faces production challenges. They're not calculating that 5 years of cumulative deficits have drained stockpiles to the point where there's nothing left to buffer the next shock. And make no mistake, the next shock is coming. Whether it's another tariff announcement, another supply disruption, another currency crisis, or simply the moment when enough industrial users demand delivery and the paper market can't provide it. When that happens, silver isn't going to politely drift higher. It's going to gap. And the people telling you to sell at $114 are going to be the same ones telling you it's too expensive to buy at $140. Here's what you need to understand. This is about recognizing that we're in the middle of a structural repricing event where old assumptions about silver's value are being destroyed and rebuilt. The market spent years in a range that made no sense. That disconnect was the result of paper market leverage masking physical scarcity. What we're witnessing now is the reconciliation, the moment where paper claims meet physical reality. And that reconciliation has only one historical outcome: higher prices, sudden moves, and a permanent loss of confidence in the idea that silver is just another tradable commodity. So while the financial media runs headlines about the bull market being over, ask yourself, do they understand that demand is outpacing supply by hundreds of millions of ounces? Do they know inventories are at critically low levels? If they don't understand those fundamentals, why trust their opinion on where price is headed? The truth is, most analysts are using old frameworks for a market that's fundamentally transformed. Silver is now a strategic resource. Governments are restricting exports. Industries are stockpiling. And all of this is happening while mine production remains flat. This is what a commodity looks like when it transitions to strategic necessity. The price doesn't peak and reverse. It reprices to reflect its actual role in the system. Remember, the goal is to understand what's happening beneath the surface so you can make informed decisions instead of emotional ones. Silver isn't acting like a speculative bubble. It's acting like a critical material whose supply chain is fracturing while demand explodes. The people telling you the bull market is over are missing the story. This is about industrial users competing for a finite resource. This is about paper promises getting tested against physical delivery. And when you understand that, you realize we're at the beginning of the phase where the market internalizes what these supply deficits mean. When silver approaches those higher levels, the question won't be, should you sell? It'll be, what does this price signal about the system? And the answer will tell you that monetary confidence is weakening, trade stability is eroding, and physical assets are being repriced to reflect real risk. In that context, calling tops on silver isn't brave, it's just early. Watch another video here to stay ahead of what's coming next.